Okay, y'all, I'm going to go over some general adjusting journal entries in this video, and then I will get to a loan adjusting journal entry in a next video. So we're going to approach these from two angles, first revenues and then expenses. So don't worry about that you can't see the expenses yet. We'll get there after we talk about revenue. So I want you guys to think about these adjusting journal entries. The whole reason why we're doing these, you guys, is because we produce financial statements at the end of every year. Right, on 12/31 for this class. And we need to make sure that those financial statements are accurate. We need to make sure we recorded all of our revenues and all of our expenses and any related assets or liabilities properly. Okay, so whatever way it best helps you to think through this is either through we need to make sure we record assets or liabilities, or we need to record revenues and expenses. The other will flow out from one another. So I'm going to talk through it in the way of approaching it from revenues and expenses, because that's typically the most conceptual for students. So we can only record revenues when we've actually earned them, right? That was accrual accounting. You guys know that. So that's what I want you to think about as you go through these two different examples. Is that revenues we can only record if we actually have earned them. So this first example is that we've earned the revenue, so we've done some work for it, right? But we just haven't received any cash for it yet. So here's an example. We earned $300 of revenue for which we haven't been paid, right? So is there any initial journal entry? Well, no, because there's no transaction actually occurring, right? Initially, we're just performing some work. Now, the adjusting journal entry, all of my adjusting journal entries, these are all happening on 12/31. So these are the ones that we care about that adjust our actual financial statements before we produce them at the end of the year. So we've earned this money, but we haven't actually recorded it yet, right? So we need to record that we've earned some revenue, which is a credit. So let me move this way. I will credit my revenue for 300, right? Now, one thing to remember is in adjusting journal entries, there's always one income statement account and one balance sheet account. So we've taken care of the income statement account. What is the balance sheet account that it's related to? Okay. In this case, it's revenue that we haven't yet been paid for, but we will eventually get paid for it, right? So things that we will get paid for are recorded in accounts receivable for that 300. Okay. Now later, when we actually get paid, so get paid, we'll take off that, there we go. We will debit our cash, saying we're receiving that cash for 300, and take off our AR, okay? But that's not the adjusting journal entry. This is the one that I'm concerned about for you. I just am writing this out so you can understand what's going on here. The AR, essentially what we're doing is we're recording revenue and then setting aside an accounts receivable until we're actually paid later on the next year sometime. Okay, so think about it like that. We have to record the revenue. As such, we just set it aside in an accounts receivable until we actually get paid later. Okay? So let's move on to the next one. This is revenues that we've received. So we've been paid for them, but we haven't actually earned those revenues yet. So if we haven't earned those revenues, can we record the revenue? No, because we have to do the work for it. Remember, we record revenues when they're earned. So initially, we received $1,200 cash. So I'm just going to debit my cash account for the $1,200. And I can't record the revenue. We already decided that because I haven't actually earned it yet. So, and this was on 9/1. So this initial journal entry will be on 9/1 year 1. I won't draw the timeline now. Okay, 9/1 year 1. We get the cash, and because we haven't earned it yet, I'm going to record it as unearned revenue, which is a liability showing that I owe someone else for this cash that they've given us, right? Okay, it's similar to, you can think about why are we setting up a liability? Well, if we take out a loan, we get cash, and then we have to set up a liability. Similarly, it's not a loan here, but we're receiving money for things that we're going to do in the future, so we have to set up the liability for that. Now, the adjusting journal entry, remember the fact said received $1,200 in advance for 12 months of service on 9/1 of year 1. So that's when we initially got the cash. Now remember, our adjusting journal entry is the one that's happening on 12/31. So how many months have we actually performed the service? September from 9, September, October, November, December. We've performed 4 months of service. So if we look at our unearned account, which is a liability, unearned revenue, I put $1,200 in. At the end of the year, do I want that to show $1,200 that I owe them still? No, I've actually earned $400, right? So I'm going to take out $400 from the liability. So I will debit unearned revenue for $400. Now remember, in adjusting journal entries, there's always one income statement account and one balance sheet account. So if we're taking off the balance sheet account, what is the income statement account related to it? Revenues, right? We've actually performed the work. That's the whole reason why we're recording this adjusting journal entry in the first place. So we need to record revenues of the $400. Now, does this make sense that there's $800 remaining in the unearned? Yes, because this ending balance shows how much we owe at the end of the year. At the end of the year, we still owe them January through and the end of August in year 2, their worth of that contract, right? So that makes sense. And then this is our adjusting journal entry. Okay? Subsequently, in the next year, we'd have to reverse the remaining $800 just like this. And the whole reason is because we can only record this $400 of revenue in the year that we've actually earned it. Okay? So remember, that's the revenue side. Now let's get over here and talk about the expenses. So remember, expenses we can only record when consumed, right? So they're same kind of idea as revenues, only it's when we've actually used something up instead of created some value. So the first example is when we've consumed something but we haven't paid for it yet, right? Does that happen in real life? Yes, it does. Great example is wages, right? So here's an example. As of 12/31 year 1, I have consumed or used up $2,000 in wages from my laborers, right? But I won't pay them until January 4th of year 2. Okay? There's no initial journal entry because what we're saying here is all we've done is they've just been doing work for us. We haven't recorded anything regarding it yet, and we need to record it on 12/31 for our financial statement. So 12/31 is our adjusting journal entry. Is this regarding an expense or revenue? Well, it's regarding expense, right? That shouldn't be a hard question. We need to record $2,000 of wage expense. So I'm going to debit wage expense to show more wage expense for the $2,000, right? $2,000 of wage expense. I need to reflect this on my income statement showing that I've used up this much wage expense in this period, right? And because we haven't paid it yet, where do we set things that we are going to pay in the future? Well, in liabilities and in a payable. So wages payable is what I would set up. You can think of this as essentially what we're doing is we need to record this wage expense in year 1, right? Because it's relating to year 1. We've used this labor up in year 1. So we need to record this now. But since we're not paying it, we essentially just set it aside in this wages payable. And later when we actually pay the cash, so when we pay the cash, we will take off that wages payable, so debit the wages payable, and credit cash for that same amount, right? Now you'll see in the practice exam, they make it a little bit more complicated, and they talk about, they give us some more wage expense in year 2, and we will go over that in the exam review. And if you have questions on it, let me know. Okay, so the second example of an expense, for adjusting journal entries, is that we've paid for an expense, but we haven't used it up yet, right? Are there examples of this in real life? Yes, these are our prepaids, right? We've talked about this in class quite a bit. These prepaids we've paid in advance, but we haven't actually consumed anything, so we can't record the related expenses. So here's our example. We paid $1,200 in advance for 12 months rent on August 1st of year 1. Okay, so our initial journal entry, we're actually paying for something. So we're going to take out cash for $1,200. And we will debit an asset, okay? Because all that's happening here is we're trading cash for a promise for someone to let us be in this rental, right? Our adjusting journal entry happens on 12/31. So this one happened on August 1st, right? So on 12/31, how much of this rent have we actually consumed? Why do I care? Because I can only record the expense for how much I've consumed this year. So I've started on August 1st, August, September, October, November, December. I consumed 5 months worth of service, of rent rather, so I have to record rent expense of $500, saying I've actually consumed that amount of value, right? And what's my credit? Well, think about this asset account you have right here, this prepaid rent. So initially, prepaid rent expense, initially you put in $1,200, correct? Now, at the end of the year, is there really $1,200 worth of value left in that asset? No, not really. In fact, we've used up 500 of it, we've already said, so we need to take out 500, right? So I'm going to credit my prepaid rent expense account for 500. So you see one income statement account and one balance sheet account. It always holds true. So if you're struggling remembering that, just go through there. So does it make sense? One last thing on this I want to talk about. Does it make sense that there's $700 remaining in my asset account? Well, yes, because we have January through the end of July still left in value at the end of the year, 12/31. Okay? All right. And I want to talk about one more thing. I'm going to erase this and do it next to it so you can see. So here's an example of it's the same facts as this given right here, right? Same facts, only instead the initial journal entry they recorded it wrong and they put it all into rent expense. So they debited rent expense for the $1,200 and then they credited cash. That was their initial journal entry, right? Let's give us some more room here. So they debited rent expense and credited cash. Okay, if that's the case, then let's draw our rent expense T account out. We just put in $1,200. We're showing that we consumed $1,200 worth of value currently, right, according to the initial journal entry. Now, what would my adjusting journal entry be? Well, how much have we actually consumed? We already decided over here we've only consumed August, September, October, November, December. We've only consumed $500 worth of rent expense, right? So in order to get our rent expense down to $500, I need to credit rent expense, reducing how much I recorded previously by $700. And I never initially put on a prepaid rent, so I need to put that on now, saying that I have $700 worth of value left remaining at the end of the period, which is the same as what we had before, right? We're just approaching it from two different ways. Now, is this important to remember? Yes, you'll see something like this on the exam. What I would suggest is draw the T accounts out and think about rent expense, right? Think about how much have we consumed. That's how much I need to show at the end of the year. So what do I need to adjust that for? And that's how much I'm going to put in my prepaid for the year. Okay? Let me know if you have questions, and good luck.